Hello, neighbors, and welcome back to the neighborhood. I am Squealer D, and I am back again. And this time, friends, we are back in the world of finance. It is Tuesday morning, and we are going to learn what are options, guys. We talk about options on here. We've never traded options, but we have heard of them. So today we are going to go a little bit more in depth so that we have a wider breadth of knowledge on them. So this is obviously an Investopedia article. We like to read those called What Are Options? Types, Spreads, Example, and Risk Matrix. So this is written by James Chen. There he is. He's an expert trader. Then we have Gordon Scott, who reviewed it, and Timothy Lee. Alrighty. So let's get going. I have morning coffee, guys. Today, I told you I was getting a new espresso machine, but I didn't know how to use it. Well, this weekend, I learned to use it, guys. And this morning, I made my very own first solo cup. That's right. D for dinero, because we're all about the money today, guys. Money talk. But it's good. It's not, guys, my first, I don't know what it's called. What's it called? Espresso, and then you put a little bit of steamed milk in it. What's that? A cappuccino? Or is that a latte? I don't know, but I made it. What I did was I made me a shot of espresso out of an espresso maker. Yeah. And then I steamed the milk all by myself and poured it in and made myself a drink. And it is delicious, guys. If you go to Starbucks and spend lots of money on coffee every single month, you should invest in your own coffee maker. I'm going to tell you why. Because it's better, guys. It tastes so good when you make it yourself. It's like good feelings and good coffee at the same time. Like this cup of coffee probably cost me 52 cents. But if I went and got it at Starbucks, it would probably cost me this cup is probably a grande. So like $5.97 I saved. So I saved like $5 on this cup of coffee. That's right. That $5 could go towards your option account, guys. You could start trading options. Maybe not options, but you know what I mean. You can get yourself on the stock market if you just start saving your coffee money. And you can have good coffee at home. You guys know how fun it is to make your own coffee at home? I'm going to start showing you guys how to make it. I tried to record it this morning, but I couldn't hold my phone and make the coffee. So I got to figure out how, I got to put my phone on something. I could get myself, like a stand. What are they called? A tripod for my phone. But I don't know. Anyway, let us get started on learning about options. And then we're going to bop over here to Yahoo Finance and check out the news. And I still want to check out our Investopedia stock trade that we have going on, guys. It's called the Investopedia Simulator. Anyway, let us get started. Option is a financial instrument that is based on the value of underlying securities, such as stocks. What is an option? The term option refers to a financial instrument that is based on the value of underlying securities, such as stocks. An options contract offers the buyer the opportunity to buy or sell depending on the type of contract they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. Each options contract will have a specific expiration date by which the holder must exercise their option. The stated price on an option is known as the strike price. Options are typically bought and sold through online or retail brokers. The key takeaways of this article are options are financial derivatives that give buyers the right, but not the obligation, to buy or sell an underlying asset at an agreed upon price and date. So it's like they're giving you insurance to buy it. They're saying on Friday for $5, you can buy this, but you don't have to. Got it. Call options and put options form the basis for a wide range of option strategies designed for hedging, income, or speculation. Options trading can be used for both hedging and speculation, with strategies ranging from simple to complex. Although there are many opportunities to profit with options, investors should carefully weigh the risks. Understanding options. And guys, you could bop on here and watch this little 4-minute and 23-second video. They're actually pretty helpful. I don't like to play them on here just because, it's not right to play somebody else's video on your video. We could read their content and learn. But if you want to watch this, you should bop over to Investopedia and check it out. They got some great they got some great stuff over here, guys. That's why we like to use it. So options are versatile financial products. These contracts involve a buyer and a seller, where the buyer pays a premium for the rights granted by the contract. Call options allow the holder to buy the asset at a stated price within a specific time frame. Put options, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. So call options, guys, allow you to buy it. They call you over to buy it. And put options allow you to put it for sale. Put it up for sale. Okay, I can remember that. They call you to buy it, and you could put it up for sale. I have to make little things to remember, guys. Sorry, but if you have a hard time with your memory, you will understand. I like to tie things to memories so that if I ever hear somebody say, I got to put this up for sale, then I'll remember that put options are sell. And it's just a trick of my mind to remember things. It's okay. You can do that too. Each call option has a bullish buyer and a bearish seller, while put options have a bearish buyer and a bullish seller. So a call option, something that you want to buy, they call you to buy it, has a bullish buyer. That meaning you are buying it because you want it to go up, right? And a bearish seller, so they're thinking it's going to go down. A put option, something you're going to sell, you would want it to have a bearish buyer, meaning they're going to buy low and you're going to sell high, because that's the way you want to do it. Buy low, sell high on the market, guys, for anything you do. That's the goal, right? Traders and investors buy and sell options for several reasons. Options speculation allows a trader to hold a leveraged position in an asset at a lower cost than buying shares of the asset. Investors use options to hedge or reduce the risk exposure of their portfolios. One second, guys. Just got to pull up the chat in case somebody joins us. We don't want to miss you. In some cases, the option holder can generate income when they buy call options or become an options writer. Options are also one of the most direct ways to invest in oil. For options traders, an options daily trading volume and open interest are the two key numbers to watch in order to make the most well-informed investment decisions. American options can be exercised any time before the expiration date of the option, while European options can only be exercised on the expiration date or the excise date. Exercising means getting strong. No, means utilizing the right to buy or sell the underlying security. Okay, types of the options. Calls. A call option gives the holder the right, but not the obligation, to buy the underlying security at the strike price on or before expiration. A call option will therefore become more valuable as the underlying security rises in price. Calls have a positive delta. And we're going to learn what delta is, guys. I don't want to lose you. Big words, lots of words, small words, words we don't understand. But we're gonna. So just stick with it. My hair is in my face. Okay. So, a long call. I got allergies so bad today, guys. My whole face is itchy. A long call can be used to speculate on the price of the underlying rising, since it has unlimited upside potential, but the maximum loss is the premium paid for the option. So, if you do a long call to speculate on the price of the underlying rising, okay, so if you think something's going to rise up, you could put a call on it, a long call, since it has unlimited upside potential. So it could keep going up all the way to $1 billion per share. But the loss that you have is how much you paid for it, right? A put, opposite to call options, a put gives the holder the right, but not the obligation, to instead sell the underlying stock at the stock price on or before expiration. A long put, therefore, is a short position in the underlying security. Since the put gains value as the underlying price falls, they have a negative delta. Protective puts can be purchased as a sort of insurance, providing a price floor for investors to hedge their positions. So if you think that it's going to go down, guys, you could put a put and say you're going to sell your stock when it gets to this level. You'll get paid for that, guys, and your stock will sell. So you will have like insurance on your stock. The price fell, but you made up the difference with a put. American versus European options. American options could be exercised at any time between the date of purchase and the expiration date. European options are different from American options in that they can only be exercised at the end of their lives on the expiration date. The distinction between American and European options has nothing to do with geography, only with early exercise. Many options on stock indexes are of the European type. Because the right to exercise early has some value, an American option typically carries a higher premium than an otherwise identical European option. This is because the early exercise feature is desirable and commands a premium. A fast fact: in the U.S., most single stock options are American, while index options are European. So single stock is like you buy an option on one stock, so maybe just Apple. But an index is like the whole S&P, like everything. The S&P 500 is an index. It includes all the 500 most popular stocks. So in the U.S., most single stock options are American, while index options are European. Special considerations. Options contracts usually represent 100 shares of the underlying security. The buyer pays a premium fee for each contract. For example, if an option has a premium of 35 cents per contract, buying one option costs $35. 35 cents times 100 equals $35. The premium is partially based on the strike price, or the price for buying or selling the security until the expiration date. Another factor in the premium price is the expiration date. Just like with that carton of milk in the refrigerator, the expiration date indicates the day the option contract must be used. The underlying asset will determine the use-by date. For stocks, it's usually the third Friday of the contract's month. Options spreads. So what's an option spread? Option spreads are strategies that use various combinations of buying and selling different options for the desired risk-return profile. Spreads are constructed using vanilla options and can take advantage of various scenarios such as high or low volatility environments, up or down moves, or anything in between. Important. Spread strategies can be characterized by their payoff or visualization of their profit-loss profile, such as bull call spreads or iron condors. An iron condor, guys, that's like when its wings are like spread open. Let's look at an iron condor. Look at it. So it goes up, iron condor. An option strategy consisting of 2 puts, 1 long and 1 short, and 2 calls, 1 long and 1 short, and 4 strike prices, all with the same expiration date. An iron condor. 2 puts, 2 calls, and 4 strike prices. Wow. What's a bull call spread? An option trading strategy that involves buying 1 call option and simultaneously selling 1 call option of the same expiry but a higher strike price. Wow. So, options risk matrix, the Greeks. The options market uses the term the Greeks to describe the different dimensions of risk involved in taking an options position, either in a particular option or a portfolio. These variables are called Greeks because they are typically associated with Greek symbols. Each risk variable is a result of an imperfect assumption or relationship of the option with another underlying variable. Traders use different Greek values to assess option risk and manage option portfolios. Delta, which is a little triangle pointing up, represents the rate of change between the option's price and a dollar change in the underlying asset's price. In other words, the price sensitivity of the option relative to the underlying. Delta of a call option has a range between 0 and 1, while the delta of a put option has a range between 0 and -1. For example, assume an investor is long a call option with a delta of 0.50. Therefore, if the underlying stock increases by $1, the options price would theoretically increase by 50 cents. So it's a long option with a delta of 0.50. A dollar change in, okay, so represents the rate of change between the options price and a dollar change in the underlying. So if it increased by $1, the options price would theoretically increase by 50 cents. Okay, so a little bit of math there. It's okay, guys. We can keep going, keep pushing, even if the math is a little bit confusing. You'll get it. Delta also represents the hedge ratio for creating a delta neutral position for options traders. So if you purchase a standard American call option with a 0.4 delta, you need to sell 40 shares of stock to be fully hedged. Net delta for a portfolio of options can also be used to obtain the portfolio's hedge ratio. A less common usage of an options delta is the current probability that it will expire in the money. For instance, a 0.4 delta call option today has an implied 40% probability of finishing in the money. Theta, which is a circle with a negative sign, represents the rate of change between the option price and time or time sensitivity, something known as an option's time decay. Theta indicates the amount an option's price would decrease as the time to expiration decreases, all else equal. For example, assume an investor is long an option with a theta of negative 0.50. The option's price would decrease by 50 cents every day that passes, all else being equal. If 3 trading days pass, the option's value would theoretically decrease by $1.50. Theta increases when options are at the money and decreases when options are in and out of the money. Options closer to the expiration date also have accelerating time decay. Long calls and long puts usually have negative theta. Short calls and short puts, on the other hand, have positive theta. By comparison, an instrument whose value is not eroded by time, such as stock, has 0 theta. So if it decreases over time, then what? It has a negative theta. Long calls and long puts. Short calls and short puts have positive. 0 theta is no erosion. Okay, so long calls and long puts have negative theta. Short calls and short puts have positive theta. And that's because theta represents the change between time. So it's time sensitive. So a short would have positive, long would have negative. Got it. Okay. Keep following, guys. It's okay. We're going to do this stuff way more if we get into options trading. When you get there, you will understand it. This is just the basics. We have to put our foot in it before we crawl all the way in, right? Finish that coffee, get some water. So, gamma, which is an upside down L, represents the rate of change between an option's delta and the underlying asset's price. This is called second order, second derivative, price sensitivity. Gamma indicates the amount the delta would change given $1 more. Let me restart this. This is called second order, second derivative, price sensitivity. Gamma indicates the amount the delta would change given $1 move in the underlying security. Let's assume an investor is long one call option on hypothetical stock XYZ. The call option has a delta of 0.50 and a gamma of 0.10. Therefore, if stock XYZ increases or decreases by $1, the call option's delta would increase or decrease by 0.10. So the gamma is 0.10 to $1, so it would be 0.10. Gamma is used to determine the stability of an option's delta. Higher gamma values indicate that delta could change dramatically in response to even small movements in the underlying price. Gamma is higher for options that are at the money and lower for options that are in and out of the money, and accelerates in magnitude as expiration approaches. Gamma values are generally smaller the further away from the date of expiration. This means that options with longer expiration dates are less sensitive to delta changes. As expiration approaches, gamma values are typically larger as price changes have more impact on gamma. Option traders may opt to not only hedge delta, but also gamma in order to be delta gamma neutral, meaning that as the underlying price moves, the delta will remain close to zero. So, sorry guys, got allergies today. My throat is still dry. So, Vega represents, and that's just a V, represents the change between an option's value and the underlying asset's implied volatility. This is the option's sensitivity to volatility. Vega indicates the amount an option's price changes given a 1% change in implied volatility. For example, an option with a Vega of 0.10 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 1%. Because increased volatility implies that the underlying instrument is more likely to experience extreme values, a rise in volatility correspondingly increases the value of an option. Conversely, a decrease in volatility negatively affects the value of the option. Vega is at its maximum for at-the-money options that have longer times until expiration. Those familiar with the Greek language will point out that there's no actual Greek letter named Vega. There are various theories about how this symbol, which represents the Greek letter nu, found its way into stock trading lingo. Rho, which is P, represents the rate of change between an option's value and a 1% change in the interest rate. This measures sensitivity to the interest rate. For example, assume a call option has a rho of 0.05 and a price of $1.25. If interest rates rise by 1%, the value of the call option would increase to $1.30, all else being equal. The opposite is true for put options. Rho is greatest for at-the-money options with long times until expiration. Minor Greeks. Some other Greeks which aren't discussed as often are lambda, epsilon, voma, vera, speed, zoma, color, and ultima. These Greeks are second or third derivatives of the pricing model and affect things like the change in delta with the change in volatility. They are increasingly used in options trading strategies as computer software can quickly compute and account for these complex and sometimes esoteric risk factors. Advantages and disadvantages of options. Buying call options. As mentioned earlier, call options allow the holder to buy an underlying security at the stated stake price by the expiration date, called the expiry. The holder has no obligation to buy the asset if they do not want to purchase the asset. The risk to the buyer is limited to the premium paid. That means your only risk is what you paid to buy it. Fluctuations of the underlying stock have no impact. So even if the stock goes down, you don't lose money just because you bought, right? Buyers are bullish on a stock and believe the share price will rise above the strike price before the option expires. If the investor's bullish outlook is realized and the price increases above the strike price, the investor can exercise the option, buy the stock at the strike price, and immediately sell the stock at the current market price for a profit. So what they did was they said, we think that this stock, maybe Apple, is going to go up. So what we're going to do is we're going to buy an option and say that we think it's going to go up, but buying it at that strike price, whatever that strike price was, is going to be lower when it goes up, right? The strike price is still going to be down here, and now the stock's going to be way up here off the charts, right? Because it went up. You were right. So you get to buy for this price, guys, and immediately sell it for this price up here and gain all that money in between. For instance, perhaps you buy it way down here at $41, and then it goes up to $57 right here, guys. And that means that it went up $12, right? $15? I don't know, whatever, guys. So you would make each of that for 100 stocks. You'd make $150 off that if you knew that it was going to go up or down. So their profit on this trade is the market share price less the strike share price plus the expense of the option, the premium, and any brokerage commission to place the orders. So there are other fees, guys. Don't forget that you'll always have a brokerage fee, the price of the option. There will be other, you can't just say, oh, you're going to make $15 a share and that's it. Well, minus fees, guys. Everything has fees. So the result is multiplied by the number of option contracts purchased, then multiplied by 100, assuming each contract represents 100 shares. If the underlying stock price does not move above the strike price by the expiration date, the option expires worthlessly. The holder is not required to buy the shares, but will lose the premium paid for the call. So if you're wrong, guys, and you buy here and you think it's going to go up and it doesn't go up, it goes down, well, you just lose your money. Womp, womp, womp. Selling call options. Selling call options is known as writing a contract. The writer receives the premium fee. In other words, a buyer pays the premium to the writer or the seller of an option. The maximum profit is the premium received when selling the option. An investor who sells a call option is bearish and believes the underlying stock's price will fall or remain relatively close to the option's strike price during the life of the option. If the prevailing market share price is at or below the stock price by expiry, I can't say that word, expiry. I don't even know if that's how you say the word. The option expires worthlessly for the call buyer. So if you think something's going to fall, you sell an option, known as writing a contract. The option seller pockets the premium as their profit. So whatever they pay you for that premium, that's your profit. The option is not exercised because the buyer would not buy the stock at the stock price higher than or equal to the prevailing market price. However, if the market share price is more than the strike price at expiry, the seller of the option must sell the shares to an option buyer at that lower strike price. In other words, the seller must either sell shares from their portfolio holdings or buy the stock at the prevailing market price to sell to the call option buyer. The contract writer incurs a loss. How large of a loss depends on the cost basis of the shares they must use to cover the option order, plus any brokerage order expenses, but less any premium they received. So, if the person decides to buy, you're going to have to buy those stocks at a higher price and sell them to them and take the loss because you were wrong. As you can see, the risk to call writers is far greater than the risk exposure of call buyers. The call buyer only loses the premium. The writer faces infinite risk because the stock price could continue to rise, increasing losses significantly. Buying put options. Put options are investments where a buyer believes the underlying stock's market price will fall below the stock price on or before the expiration date of the option. Once again, the holder can sell shares without the obligation to sell at the stated strike price per share, priced by the stated date. So if you think the price is going to fall, you could buy a put option and sell with no obligation if you don't want. Since buyers of put options want the stock price to decrease, the put option is profitable when the underlying stock's price is below the strike price. So you buy it, if the stock goes below that price, bam, 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 you win. If the prevailing market price is less than the strike price at expiry, the investor can exercise the put. They will sell shares at the option's higher strike price. Should they wish to replace their holding of these shares, they may buy them on the open market. So what they can do is they get to buy at a lower price, which means that they can sell right away at market price and make the money and profit. Their profit on this trade is the strike price less the current market price plus expenses, the premium and any brokerage commission to place the orders. The result would be multiplied by the number of option contracts purchased, then multiplied by 100, assuming each contract represents 100 shares. The value of holding a put option will increase as the underlying stock price decreases. Conversely, the value of the put option declines as the stock price increases. The risk of buying put options is limited to the loss of the premium if the option expires worthlessly. So as you can see, it has a limited loss. Some of these do not have limited loss, guys. This one up here, the loss could be indefinite if the price keeps rising. So you have to know the risk and the loss, guys, what you can lose. Selling put options. Selling put option is also known as writing a contract. A put option writer believes the underlying stock price will stay the same or increase over the life of the option, making them bullish on the shares. Here, the option buyer has the right to make the seller buy shares of the underlying asset at the strike price on expiry. If the underlying stock price closes above the strike price by the expiration date, the put option expires worthlessly. The rider's maximum profit is the premium. The option isn't exercised because the option buyer would not sell the stock at a lower stock price when the market price is more. If the stock's market value falls below the option strike price, the rider is obligated to buy shares of the underlying stock at the stock strike price. In other words, the put option will be exercised by the option buyer who sells their shares at the strike price as it is higher than the stock's market value. The risk for the put option rider happens when the market price falls below the strike price. The seller is forced to purchase shares at the strike price at expiration. The rider's loss can be significant depending on how much the shares depreciate. The rider or the seller can either hold on to the shares and hope the stock prices rise back up above the purchase price, or sell the shares and take the loss. Any loss is offset by the premium received. An investor may write put options at a strike price where they see the shares being a good value and would be willing to buy at that price. When the price falls and the buyer exercises their option, they get the stock at the price they want with the added benefit of receiving the option premium. The pros: a call option buyer has the right to buy assets at a lower price than the market when the stock's prices rise. The put option buyer profits by selling stock at the strike price when the market price is below the strike price. Option sellers receive a premium fee from the buyer when writing an option. The cons: the put option seller may have to buy the asset at a higher strike price than they would normally pay if the market falls. The call option writer faces infinite risk if the stock's price rises and are forced to buy shares at a high price. Option buyers must pay an upfront premium to the writers of the option. Suppose that Microsoft shares trade at $108 per share, and you believe they will increase in value. You decide to buy a call option to benefit from an increase in stock's price. You purchase one call option with a strike price of $115 for 1 month in the future for 37 cents per contract. Your total cash outlay is $37 for the position plus fees and commissions. If stock rises to $116, your option will be worth $1, since you could exercise the option to acquire the stock for $115 per share and immediately resell it for $116 per share. The profit on the option position would be 170.3% since you paid 37 cents and earned $1. That's much higher than the 7.4 increase in the underlying stock price from 108 to 116 at the time of expiry. In other words, the profit in dollar terms would be a net of 63 cents or $63 since one option contract represents 100 shares. $1 minus the 37 cents you paid times 100 would give you $63. If the stock fell to $100, your option would expire worthlessly and you would be out $37 premium. The upside is that you didn't buy 100 shares at $108, which would have resulted in an $8 per share loss or $800 total loss. As you can see, options can help limit your downside risk. Options terminology to know. Options trading involves a lot of lingo. Here are just some of the key terminologies to know the meanings of. At the money, ATM. An option whose strike price is exactly that of where the underlying is trading. ATM options have a delta of 0.50. In the money, an option with intrinsic value and a delta greater than 0.5. For a call, the strike price of an in-the-money option will be below the current price of the underlying. For a put, above the current price. Out of the money. An option with only intrinsic value and a delta of less than 0.5. For a call, the strike price of an out-of-the-money option will be above the current price of the underlying. For a put, below the current price. A premium is the price paid for an option in the market. A strike price, the price at which you can buy or sell the underlying, also known as the exercise price. Underlying, the security upon which the option is based. Implied volatility, the volatility of the underlying, how quickly and severely it moves as revealed by the market prices. Exercise, when you get strong and buff. No, guys. When an options contract owner exercises the right to buy or sell the strike price, the seller is then said to be assigned. Expiration, the date at which the options contract expires or ceases to exist. Out of the money options will expire worthless. How do options work? Options are a type of derivative product that allows investors to speculate or hedge against the volatility of an underlying stock. Options are divided into call options, which allow buyers to profit if the price of the stock increases, and put options, in which the buyer profits if the price of the stock declines. Investors can also go short an option by selling them to other investors. Shorting or selling a call option would therefore mean profiting if the underlying stock declines, while selling a put option would mean profiting if the stock increases in value. What are the main advantages of options? Options can be very useful as a source of leverage and risk hedging. For example, a bullish investor who wishes to invest $1,000 in a company could potentially earn a far greater return by purchasing $1,000 worth of call options on that firm, as compared to buying $1,000 of that company's shares. In this sense, the call options provide the investor with a way to leverage their position by increasing their buying power. On the other hand, if that same investor already has exposure to that same company and wants to reduce that exposure, they could hedge their risk by selling put options against the company. What are the main disadvantages of options? The main disadvantage of options contract is they are complex and difficult to price. This is why options are considered to be a security most suitable for experienced professional investors. In recent years, they have become increasingly popular among retail investors. Because of their capacity for outsized returns or losses, investors should make sure they fully understand the potential implications before entering into any options position. Failing to do so can lead to devastating losses. How do options differ from futures? Both options and futures are types of derivative contracts that are based off of some underlying asset or security. The main difference is that option contracts grant the right but not the obligation to buy or sell the underlying in the future. Futures contracts have this obligation. Is an options contract an asset? Yes. An options contract is a derivative security, which is a type of asset. The bottom line, options are a type of derivative product that allow investors to speculate or hedge against the volatility of an underlying stock. Options are divided into call options, which allow buyers to profit if the price of the stock increases, and put options, in which the buyer profits if the price of the stock declines. Investors can also go short an option by selling them to other investors. Shorting or selling a call option would therefore mean profiting if the underlying stock declines, while selling a put option would mean profiting if the stock increases. So, practice trading money. Look at it. So, if you invested $100,000 in Tesla 5 years ago, you'd have $8,000 today. What about Apple? You'd have $3,000. What about Nike? $2,000. What about Amazon? $1,900. Walmart? $1,800. So, if you would have invested in Tesla 5 years ago, let's see, what about if you would have did it 10 years ago? Whoa! You guys see that? If you'd invested $1,000 in Tesla stock 10 years ago today, the investment would be worth $94,000. Boy, oh boy. Walmart's not that much, huh? Amazon, though. Nike. Apple. I wonder what the new Tesla is going to be, guys. What do you think is going to be the new Tesla 10 years from now that's going to be the 94,000? Something probably like rockets. Something new. But that is it for this, guys. We read through the entire article. There are some great like how to trade related articles, essential trading, and we're going to check out a lot of these. We're going to learn all of the basics of option prices. We're going to learn all of this, guys. This was just our introduction, okay? So, let us close this out. Like I said, it's Investopedia. If you guys want to go check it out and watch that little video right there, check out some of these other articles, but we're going to get into them. So let us go and check out the news. Magnificent Seven. Tech stocks drive market rally amid AI mania. So maybe AI, guys. Maybe the AI will be the new Tesla, right? Debt ceiling. What short-term extension means for U.S. Another extension, guys. Since they started this negotiating over our debt, 13 years ago or whatever, whenever Obama did it, whenever they started negotiating over debt, they ruined it for us. Like, we will never, ever not negotiate and lose things during it. You guys, we raise our debt limit too high to tie it to things that they can, like, anybody on either side. If we tie our debt limit to negotiations, we'll have to negotiate every single time, right? We have had 78 debt limit. Our ceilings have rose 78 times in 63 years. If we're negotiating every time, how is that going to work? It's not going to work. Oh, Charlie Munger says we're nearing a mild recession. I've been saying we're in a recession for the last 7 months, but they don't want us to be in a recession, guys. Nobody wants to be in a recession. I mean, but when things are like it is, with inflation as high as it is, and people are using their credit cards for everything, is pretty much saying we're in a recession. Charlie Munger, the 99-year-old billionaire and vice chairman of Berkshire Hathaway, expressed his concerns about the United States heading toward another fiscal crisis. In an interview with Financial Times, Munger highlighted the problematic situation of commercial property loans held by U.S. banks, stating that many of them would be deemed as bad loans because of declining property values. He emphasized that this indicates a negative outcome for the American commercial property market. It's not nearly as bad as it was in 2008, Munger said, acknowledging that the fallout from the bursting of the bubble should not be as catastrophic as the 2008 collapse. But he cautioned that trouble can happen to banking just like it can happen everywhere else. So, not only did these bank managers invest in bonds, and then they invested in bonds, guys. And then the feds raised the rates and their bonds became worth less, right? So they had to sell their bonds at a loss. And now we are finding out that our real estate is crashing. Just like in 2008, guys, our bubble is crashing. So where people had $125,000 worth of equity in their homes, that's going away, guys. House prices are going to go back down. And that means if the real estate for us goes down, houses, things that we can buy, also the corporate commercial property is also going to go down. If you can't sell a house or an apartment building, right? If you can't sell them for an increased amount of money, you're definitely not going to be able to sell commercial property, that like a huge building that they're trying to sell for $7 million. You're not going to sell that. So if they took out all of this real estate, let's say that a bank bought a bunch of corporate real estate in a town that no longer has people working, guys. Think about this. Large corporations have work from home now. Why do you think they're making us go back to work? Because if we don't, these banks are going to have bad loans, corporate commercial property that they purchased because we used to work in the building, right? You used to go to work every day in a building until they realized that we have all this AI and we don't need to work in a building. So all these buildings that the banks bought because we had to work inside of them, now they're not worth anything, guys. And what's going to happen to all those bad loans from the bank? I'm going to tell you what's going to happen to them. We're going to pay for them. Just like when Silicon Valley Bank closed down. Do you know who's paying for that? We are. The feds, they said that them and Chase are paying for it, but it will come from us. Chase will get the money back from its people that bank there. So all of this is going to come back on us, the people. So they bought all of these big, gigantic corporate properties so that they can make tons of money off of them. And now the real estate went back down and they can't make that big money off of them. So now more banks are going to go down. And people don't think that it can happen because we are America. But guys, guess what? It's happened in America before. We had a Great Depression before. We had the 2008 housing collapse. Like the entire real estate market collapsed in 2008, guys. It's not the same kind of bubble. It's a different bubble. Of course, the banks and of course the people, the feds or the loan people for the houses didn't do the exact same thing. They did different things. Everybody says, well, it's not the same. Of course it's not the same, guys. We wouldn't allow them to do the same thing. They're doing different things. People don't do the same crime twice if they get caught the first time. They switch it up. So now we have a different type of crime. And the type of crime, let's look at what prison looks like for this lady. Oh, I can't wait for this lady to go home, to go to jail. Is expected to begin serving her 11-year sentence Tuesday at 2 p.m. inside a minimum security, female-only federal prison camp in Byron, Texas. What will her new life look like? What does FPC Byron look like? A minimum security federal prison camp. Oh, find an inmate. Find by name. What was her last name? Does that girl look like? What's that girl's name? Holmes. I thought it was the name. Holmes. Oh, what's her first name? Elizabeth. There she is. Look at her. She's not. Oh, it's 2 o'clock. 2 o'clock. 2 o'clock. I'm too early, guys. I was all excited. But they do have her down. You could send money, send a package. You could call or email. Probably them. You could visit. Wonder what you have to do to visit. Wonder what it looks like there. Are these workers? Or do you get to go there and like... I don't know. I don't know. It doesn't really look like a prison, does it? I wanted to see Byron. FPC Byron pictures. FPC Byron pictures. We want to see what this place looks like. Oh, look at him. Look at him. Federal prison boot camp. Oh, they're going to close it. I don't know. It's a boot camp before, guys. Texas prison works to make sure inmates don't come back. Look at those inmates sitting in that jail. That's where I don't ever want to be. Nope, that's not it. I just want to look at it, you know? I want to see what it's like there. Federal prison camp, Byron. Photos. Look at this. It's a prison camp. So this is where she's going to be, huh? They have like plays. What is these people? This guy right here, this is not for men. This is a woman's camp. What are all these guys doing on here? Oh, these must be the kids of the people in prison. I don't know. That guy's definitely not supposed to be in a woman's prison. Inside the routine, here we go. Yeah. There she is. What's her day going to be like? Female inmates can take classes on business skills and foreign languages, watch television, play sports, and go to religious services. Homes will be allotted an hour for each meal, which offers a prison's menu consisting of foods like chicken, hamburgers, hot dogs, tacos, and macaroni. She can speak to her family via video calls. Inmates are allowed visitors during weekends on holidays and be allowed limited physical contact with her partner and young children. This lady went and had a child thinking that she'd stay out of jail. She got 2 young kids since all this happened. Why would you go get married and have kids and then get 11 years in jail? Don't make no darn sense. Tell me why. Tell me why. Why would you go have kids? She's been ordered to pay $452 million. She better start working while she's in jail. She better start making money. I don't know how, but she better start making money. She better start up a channel. I wonder if she could, because she could have video calls, I wonder if she could make money online. I wouldn't let her make money online anymore. She rips people off. She owes people $452 million. That's crazy. I'm glad I don't have to go to no jail like that. That'd be horrible. Go sit in jail for 11 years. I wonder if she got to keep any of that money. She owes people $452 million. I hope she married a really rich guy. First divers to reach bottom of Great Blue Hole. Where's the Great Blue Hole? Belize. Wow. Look at that. How deep is it? 420 feet. Wow. What'd they reach? Look at them. Wow. Left him speechless. What'd he find? Look at it. Wow, it's so neat. It looks great from the hole. In the reef center, there's the reef. Yep. So crazy looking. A lighthouse. It's so cool looking. Why does it look like that? It's so neat. I bet you something came up out of that, guys. Like lava. Not lava. I don't know. Like the steam. Jacques Cousteau. I used to watch Jacques Cousteau when I was a kid, man. I used to want to be like Jacques Cousteau. That was my very first guy I ever looked up to, besides my pops, was Jacques Cousteau, man. I wanted to be on a boat like Jacques Cousteau. I wanted to be a marine biologist. I wanted to study all things oceanic. It was so wonderful. Richard Branson. There he is. That's Richard Branson. Well, so what'd they find at the bottom? Man, this is going on for a whole long time, huh? What'd they find? Oh, look, that's pretty cool. I want to go in that. I'd be afraid, but I would go. Well, what do they find? At first, the submarine kicked up some sediment, harming the crew's visibility. But soon, the floating underwater sediment gave way to fascinating geological formation. Caves upon caves of hanging stalactites. Wow. While stalactites are common in caves on dry ground, it's impossible for them to form underwater. So how could there be stalactites more than 20 meters under the water? For the crew, seeing cave stalactites underwater could only mean one thing. This was, in the words of Sir Richard Branson, one of the starkest reminders of the danger of climate change they had ever seen. Guys, that used to be a cave with no water. At the end of the last major ice age, sea levels in the Caribbean had risen at a rapid pace, submerging vast stretches of once dry land. At 200 feet underwater, the coloring of the rock formations changed, denoting the previous levels of seawater, before the oceans rose and drowned the cave systems above. Years before Branson, Bergman, and Cousteau had taken the Aquatica into the Blue Hole, a team of researchers from Rice University and Louisiana State University had descended into it in order to collect samples from its sheer walls at different depths. They hoped that the samples they took would help them solve a historical mystery that took place miles and miles away, deep in the jungles of Central America. Wow. A toxic layer. Foscari in the poisonous waters and crab carcasses. After battling through the thick layer of hydrogen sulfide, the team managed to reach the bottom of the pit, a feat never before accomplished by a manned vessel. Fabian was especially excited. He'd be able to pick up his grandfather's work where he had left off and expand our knowledge of the oceans. The team planned to map the geological anomalies' lowest reaches and hopefully bring back some scientifically important findings. Look at them all squished in there. That thing mans 3 people? I don't know. I wouldn't want to be in there with nobody else. I feel like it's maybe one other person. But what they ended up finding beneath the heavy blanket of hydrogen sulfide would leave them terrified. What'd they find, guys? As Cousteau and his team mapped out the bottom of Belize's Blue Hole, their feeling of dread and worry grew from minute to minute. From the surface, the Blue Hole seemed like a pristine, untouched natural wonder, removed from any human influence. But as the submersible crawled across the bottom of the pit, a very different reality was revealed. Countless empty plastic bottles, bags, and garbage lined the hole's floor. The hole, like many other parts of the ocean, was found to be an underwater landfill. The team were horrified, saddened, and revolted. How could we have let this natural wonder turn into a garbage dump. As Cousteau and Bergman voiced their concern, it became clear to Sir Richard Branson that something had to be done. What started as a mission to map out an unexplored part of the planet had turned into a mission of mapping the frontiers human pollution had already conquered. The hole didn't contain any underwater beasts other than the oceanic monster of humanity's own making, pollution. Branson wasn't going to let this pass quietly. Together with Ocean Unite, a conservativist conglomerate, he decided to take action, not just to save the blue hole, but the rest of the ocean as well. Ocean Unite's stated goal is by 2030 to set aside a minimum of 30% of the world's oceans as protected areas, which would carry real legal ramifications should they be damaged. As a member of Ocean Unite, Branson attempts to combat ocean pollution whenever and however he can. Even before he embarked on this deep-sea mission, Branson had met up with the Prime Minister of Belize and his wife. Wow, they found junk. I want to see it. Where's the junk? Where is it? Oh, it's so cute. Problem with plastic. Our planet is facing many environmental catastrophes. One of the biggest ones is that of plastic waste. Guys, stop buying all this plastic crap at the dollar store. It's probably going to kill you and your children. Stop taking it into your home. Bad plastic. Look at this. Oh my gosh. This is at the blue hole? Is this at the bottom of the blue hole? All this garbage? This looks like the streets in Seattle. I tell you what. That's no good. That's no good. That was an ad, too. Debt ceiling deal is done. Why recession and stock market drop may follow. That's hopeful, huh? Why recession may follow. That's very hopeful. Let's read this little hopeful article. So, worries over the debt ceiling have had the stock market on edge, yet the Saturday night deal to avoid... No. What happened? These are... No. I'm not reading articles that have ads like that. I don't like it. What's in the debt ceiling deal? I told you they would make a debt ceiling. They had to do it too this weekend because they were talking about if they didn't have it by Tuesday, Moody's was going to lower our rating or something. So, I mean, they pretty much had to do it. What did they do? What's the Federal Reserve going to do? I say the Federal Reserve is going to raise it again. Weekly stock list. Saudi net reserves fall to $410 billion, lowest since 2010. Oh, wonder what this means, guys. Saudi Arabia's foreign reserves fell in April to the lowest in more than 13 years, an apparent sign that the kingdom hasn't yet used last year's $326 billion oil windfall to top up the central bank's holdings. Net foreign assets fell to $1.5 trillion last month, according to people are pulling their money out, guys, because people with a lot of money don't want to lose it. They do it every time. You can't think that the richest people lost all their money in 2007. It didn't happen because the same people are still rich. Berkshire Hathaway didn't lose his money, right? JP Morgan didn't lose their money, right? Billionaire Charlie Munger reveals the reason Berkshire Hathaway is sitting on $88 billion in cash. Why do they got $88 billion in cash? They tell you to never have cash. Look at him. The S&P 500 dipped by 19% in 2022, but stocks still don't seem cheap to Charlie Munger, Warren Buffett's billionaire partner at Berkshire Hathaway. In my whole adult life, I've never hoarded cash waiting for better conditions, Munger said in an interview in late 22. I've just invested in the best thing I can find. Yet he acknowledged that Berkshire Hathaway is sitting on billions of dollars in cash. The reason isn't that Buffett and Munger think they can wait for stocks to get even cheaper, the wager known as timing the market. Instead, Munger said bluntly that Berkshire isn't buying anything because there's nothing we can stand buying. In an amazing statement, even with stock market downturn that would presumably result in dozens or hundreds of stock trading on sale at bargain level prices, the world's most famous value investors aren't remotely tempted to dive in. You see what I just said? The richest people they pulled their money out, guys. They pulled their money out. They're buying options. They're buying futures. They're betting on your money in the market, you guys. That's why we're learning this. You have to know when. You gotta know when to hold 'em, know when to fold 'em, know when to walk away, know when to run. That's what you gotta do. That is the market. That song is the market. And Berkshire Hathaway, these old Buffett and Munger, these older gentlemen, this guy did not get this old, and he did not have $88 billion. Isn't that what they just said? $88 billion in cash? These dudes got $88 billion just sitting around. No freaking way. Why? Because they said, there's nothing we can stand buying. Wow. That's crazy, guys. Wow. Say wow to that. This essentially shuts Buffett out of the world of microcap investing. Unless Berkshire Hathaway decides to jump through those regulatory hoops. Oh, so they can't do some limited to what? By law, major financial institutions, billionaire investors can't buy more than 5% of a company without submitting a 13D filing as a beneficial owner of securities, and comes with it. So he can only, if a $2 million stake turned into $20 million, that wouldn't move the needle for a company that collects hundreds of millions of dollars. Okay, so nothing, he's such a big investor. That's crazy. $88 billion just sitting because he doesn't want to invest it in anything. Tesla's up. What is Tesla doing? Tesla, what you doing today? Tesla. I don't know what to think about Tesla. Concerned. I don't know. Stays so close to its MACD. You can barely even see it. Look at that. It just rides right on top of it. I wonder. Does Berkshire invest in Tesla? Warren Buffett explains not investing in Tesla despite Elon Musk's urging. So he doesn't. Warren Buffett said this weekend that he admires Elon Musk for his dedication to solving the impossible, and Tesla CEOs urged Berkshire Hathaway to invest in his electric maker. But while Berkshire Hathaway believes EVs will bring big change to the auto market, he doubts any car maker will be able to hold a dominant position. That is a very, very good outlook to have. That is how I feel. There's no way. Why do they get bad picture of these guys like this? He looks like he's about to, I don't know, spit or something. But with new EV vehicles coming from everybody, it's really hard to think that Tesla's going to stay. Like, yes, Tesla has had a very good 10 years, right? If you invested $1,000 10 years ago, you'd have $95,000. Yes, that is very good. But for the next 10 years, is it going to be so good with more people making the cars? And also, with types of things you need to make the batteries becoming harder to get, it may make the batteries less, people want them less, right? So I think that is it for today. We've hit about an hour. I don't like to go too far over, have too much for you to catch up on. If this is your first episode that you've watched of Money Talk, welcome, my friends, and I hope you enjoyed it. There are many more where this came from. If you go to the portfolio or the playlist on our YouTube called, let's see, you can go to it. I show you. So you go to YouTube, you go to my YouTube. Yeah, we got playlists, guys. You see your playlists? There's a playlist called Stock Market Learning. And you click into Stock Market Learning, guys. That's me. And you can see all of our stock market. Here it is. Come on. Come on now. There we go. Day 38, day 37, day 36, all the way back to the beginning, guys. Where is it? Where we learned about what is the stock market, stocks versus bonds, stocks for beginners. So if you go back, they're all anywhere from 30 minutes to about an hour, guys. So it's not that much to catch up on. And you can learn everything there is to learn about the stock market along with me. And that is it. I hope that you guys have a great day, and I hope you had a great holiday weekend. I will see you guys tomorrow, same time, same place. Be there or be square. Have a great day, neighbors. I'll see you.